From the morning reading, earnings reaction continued to dominate. The SPX continues to grind sideways. Amazon drops, Google up in after hours. 2 of 10 sectors moved higher on Thursday. XLV, XLF, and XLK were the strongest sectors, while XLRE was again the weakest sector. Oil futures rose 37 cents to close at 49.60. Breadth weakened compared to the prior session slightly as decliners led 21.85 to 831 on the New York Stock Exchange and led 18.28 to 894 on the NASDAQ. The SPX SPY pulls back for the third straight day as Dow leads on strength. VIX closed higher and did confirm Thursday's lower SPX close. In other morning reading, the S&P 500 snapshot, the downtrend continues. The benchmark S&P 500 rose at the open, giving hope that the downtrend since the Monday advance would reverse directions, but such was not to be. The index quickly sold off to its morning low, rallied into the lunch hour, took a pause, and then sold off during the afternoon to its negative 0.32% intraday low shortly before the close. That ended the session with a 0.30% decline and its consecutive loss, the fifth in 6 sessions. The closing yield on the 10-year note jumped 6 basis points from its previous close to 1.85%, quite a rise from its historic closing low of 1.37% in early July. Gaps keep fading. Once again on Thursday, stocks gapped up at the open, then faded during the day. These failed gaps have become more common, with 8 of them in the past 3 months as stocks meander near all-time highs. When that has happened other times over the past 35 years, stocks have tended to underperform over the shorter term. Amazon didn't meet high expectations. Wall Street has the most lopsidedly optimistic on the stock in the 17 years heading into Thursday's earnings report. Amazon has indicated the gap down more than 5% at Friday's open as a result. Other times it gapped down after earnings when it had high expectations. There was some evidence of dip buying, but it was not convincing. ETF traders had some bad timing. The NASDAQ 100 fund, QQQ, took in more than $1 billion on Wednesday, one of its largest inflows in the past 5 years. At the same time, several bond funds saw big outflows, especially LQD, which suffered its second largest one-day leak ever. Its largest loss of assets occurred on September 9th, which happened to come near the end of short-term selling pressure in the fund. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:40 a.m. Mountain Time, and I'm recording this in preparation for the market day of October the 28th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce into our morning report. And there we go. And at the time of this cut, all 4 of the U.S. broad-based indices were up slightly. The S&P up just below 0.25%. Russell futures were up just above scratch. NASDAQ and the Dow futures were up a little less than 0.25%. Crude oil's down about 0.5%. Euro's up just above scratch. Long bonds are down just below scratch, and gold is down just below scratch. And China down about 0.25%, Hong Kong down about 0.75%, Japan up about 0.2%, Germany down about 0.25%, and United Kingdom right on scratch. In terms of macroeconomic reports for today of note in the United States, you have advanced GDP and employment cost index and University of Michigan consumer sentiment. In terms of current volatility conditions, short-term VIX has popped up a little bit, but still relatively low at a 14.59. Skew still benign below 125. IV percentiles continue to grow, but they're still in the lower third of the annual range. The S&P is at a 34, the Russell at a 30, the NASDAQ at a 29, the Dow at a 31. We've had back-to-back -1 standard deviation moves on the Russell, but other than that, all the other indices on a close-to-close basis have not had any significant moves. And for the S&P, this now goes for more than 2 weeks. In terms of our current charts, there we go. Sorry about the pause there. I had not gotten something quite set up the way I wanted. So here we are with the S&P 500 futures chart. You see overnight action dipped a bit, but has reversed from that action, and we're basically right where we started in the overnight session at the time of this video recording. So what do we make of this overall action? Well, first of all, still very much finely balanced, very much in the range, in the neutral area. We've now exited the cloud to the lower side, but we're still in this, range within a range, really. You've got the larger range, and then you have a range that was kind of a little bit to the shift to the high, and then that broke down, and then a little bit lower range. But basically, we're still operating in this area between about 2100 and about 2150, which is a range between the 2100 and the 2200 roughly. And so we're in the lower part of the larger range and about the middle of the lower range. So the slight tendency towards the downside, but yet at the same time we continue to see the bulls hold, and even in overnight sessions like last night we continue to see this activity holding. Now, how long this holds, that's the grand question. And we got now, I guess it's something like 11 days to the election. Does this continue to persist all the way through to the election, or do we start to see some volatility expansion prior to that? Right now, we're still in a VIX daily squeeze, and everything would seem to say that we could persist in this sideways range action for the short term without any concerns, because that's what all the other markets are telling us as well. So we'll see. The Dow is very much as sideways as can be. And then, of course, the NASDAQ had some interesting activity in the overnight. But when it's all said and done, it's still within its own range. And frankly, you would have to, on a larger scale, just call this a bull flag at this point, with an expectation that it would move up. Seasonality would tell us in these next several trading sessions that we should have a slightly bullish bias with a pretty good probability about that. But then we also see with the Russell, the last two sessions, we've had a clear breakdown from the range. And, you have the break here, the confirmation, and then last night's activity so far in a small way building on that. So this is, starting to enter that airspace where it could easily fall all the way to around 1078. So some 100 points, that'd be a 10% move roughly on the Russell, and, well into correction territory from the relatively recent 52-week high. Is that telling us something? It's the first of the indices to actually break down. It's that small cap, growth-oriented people perhaps starting to rotate away from growth-oriented stocks more into things like the Dow. And the Dow, of course, has been holding thus far. But sometimes we do see the NASDAQ and the Russell kind of lead either to the upside or to the downside. And then other times we argue that it's really all about the S&P and the Dow. At this point, it's interesting, and I think we'll leave it at that, because when we look at the other markets, gold certainly hasn't started to show any kind of fear quotient to it. Neither has the long bonds. If anything, the long bonds yields continue to to go up, which means that the long bond value goes down. And so we continue to see this continued build of lower lows and lower highs. And so there's no fear premium being espoused there. If you look at the VIX, we've had a little bit of a pop on volatility in the last several sessions. But at the same time, we're, 15 and change. So nothing terribly exciting at this point, but we do have to recognize the short-term trend is certainly starting to point up, and you kind of wonder where that might lead. So we've got maybe some green shoots starting to give us some evidence of movement, with a little bit of movement in volatility, a little bit of movement in the Russell futures, but in general, most of these markets are still locked in their sideways. Here's crude oil, still locked right on that important support area, and it has rotated around that for multiple sessions now in terms of a closing basis. Here's close, 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 and right now current open candle, close, all rotating within just pennies of this key support now. Resistance now turns support area. So all these other markets are still locked in their sideways consolidation patterns. Only the VIX and the Russell seemingly showing the way to perhaps some downside action in equities. We'll see if they start to see some acceleration in that. We talk about change and rate of change, and indeed, let's go ahead and go to the daily report where this is most evident. And so that change, that Russell and that VIX, is that the beginning of something, and do we start to see an acceleration of the pace of that kind of activity, or is that just a false breakout and 2-3 sessions from now it's right back where it came from, which was so much of what we've seen in the past weeks as well. Market trend, intermediate term phase opinion, still locked in phase 5, the break of diagonal support. You could argue that the Russell has broken horizontal support now, though this is primarily focused on the S&P action, where the break of horizontal support has not occurred yet. In terms of the 3 market timing signals, we have from IBD our first signal, mechanical in nature, uptrend under pressure, so caution there. The second signal, the GMI index, a 4 out of 6. Some improvement on that index, but the sell signal still in place, and that sell signal's been in place since 10-12 now. And then their third mechanical signal comes from Stock Charts Decision Point Scoreboard, and you see we have a new signal to the downside, and this one was a flip in that it had recently gone positive and now has flipped right back down to negative. So short term, across all 4 of the symbols, is neutral to bearish in almost all places. We have one lone bullish symbol still holding on in the short term with the Dow. In the intermediate term, we have neutral to bearish in 3 of the 4. The NASDAQ continues to hold to its bull signals, and all 4 of them have mixed signals on the long term, and those have been in place for quite some time. So the consensus of all this right now is still finely balanced, very, very neutral market with perhaps a bit of a bias to the downside, and certainly we are getting caution signals at the very least. Position sizing opinion continues to be 50% and 75%, no change from yesterday's session. Intermediate term market posture continues to be a bit of a cautionary area as well. We have a strong bear signal, which is reinforced by a weak bear sentiment line, and 3 of the 4 indices are now in the bear camp. You have the S&P, the NASDAQ, and the Russell's in the severely strong bear, having broken down below the 20 level. Only the Dow is holding on to its weak bull status, and this could very, very easily flip over and join the other 3. In terms of hedge warning status, we do have a change here. I have gone ahead and elevated back to level 2. We had dropped to level 1 plus for about 3 sessions. when we saw a little bit of a bounce, a little bit of improvement in activities. The intermediate term market posture had turned positive briefly, but that's now rolled back over, and I think it probably appropriate to return to level 2. Very, very important that when we go up in level that we do those various action steps and watching our portfolios, understanding what our level of delta exposure is, what's already hedged in our portfolios, what needs to perhaps need a greater attention, and then also there's various hedging activities that we might start to at least prepare, if not initiate, depending on the level of portfolio hedge activities that you need. So along with that is, do we initiate new positions? Well, at level 2, for novice traders, we do not initiate new positions with respect to a number of the strategies, including the cover call strategies and put selling. We basically, on the flip side, look to perhaps close some of the positions that we have, especially those that have accrued nice profits, and we go ahead and remove that delta exposure and pocket those profits. So kind of the flip side there. And part of also while we are at level 2, so I talk about this change in rate of change. Well, look at the amount of red that is slowly but surely accelerated. And this isn't just a one-day event. Yesterday we saw some red here, but today we're seeing more. When indeed these first two both fired yesterday, market and decline, sharp increase warning. The volatility ratio warning was perhaps one of the earliest ones on this round, and that fired 3 sessions ago and certainly seems to be following through as volatility and indeed the VIX phase seems to be increasing. We've had at least four consecutive sessions with the VIX closing at a higher level and with no let up. We also have, of course, this daily squeeze, which is still in daily squeeze, ready to fire. I put that in red just to note that it is in the firing position. The other piece to this is our distribution day count has been climbing once again, and now we're at 7 on the S&P and the NASDAQ. And then also yesterday I mentioned this, actually technically at 10 days out we're still just below 40, but as you go more than 11 days out, and the election is at 11 days now, the volatility jumps to over 50. So there's expected to be some increasing volatility in the short term that is being priced into the market. In our trend-based area, we have, of course, warnings in phase 5, strong bear, and then also for back-to-back sessions, New York Stock Exchange, new highs, new lows, very, very high new low counts, and in this case over 500 now on the new lows. And then if you needed any more, the key intermarket risk aversion indicators, all 5 of those are currently in the risk off posture. So all 3 of those kind of key areas in the way we look at the market, you just see pretty much a sea of red here with almost all these indicators pointing to the negative side. So as such, I felt like it was necessary to be at a level 2 on the hedge risk level. Now, in terms of sentiment, it's still relatively benign. In fact, all 4 of these markets relatively low. Fear and greed index is still in the neutral zone. So again, we have this kind of slow motion kind of deterioration, but some acceleration on that activity. In terms of sector specific, you see here that a preponderance of red. So breadth was really poor in terms of positive action yesterday, and especially in some of these consumer staples, utilities, real estate. Some of these that we normally look at as relatively defensive, they were quite red yesterday. Most of this is related to expectations around interest rates. So that's been part of the problem. And indeed, the most consistent sector continues to be this financial sector. Healthcare had a bit of a bounce yesterday. They've been largely pummeled of late. And of course, telecom, they were all green. But remember, that's only 5 companies, and 2 of them make up, some 90% of that sector's performance. Verizon and I guess it's AT&T, if I remember right, is the 5 components there. The sector percent change, notice in the short to intermediate term, again, deterioration. We continue to see, neutral to bearish on almost all these settings, only financials now holding up across all 3 time frames. And you also see this deterioration in the percent change across the different time frames. 1 day, 5 day, 1 month, 3 month, easily dominated by the bears in a kind of slow degradation. So, nothing huge has happened yet. And while we see so many of these indicators are pointing to the bear side, you have to still say that with the exception of the Russell, that horizontal support, the key support levels have held. So we expect support to hold until it doesn't, and proven so. And so we have to give some credit to that. We have to be somewhat finely balanced in our expectations. This is not the time to necessarily load up on a whole bunch of bearish trades, but it certainly is a time to start considering increasing some bearish exposure, and perhaps at the very least observing where are we with our various components of our portfolio, and is there some actions we might want to start to take while we still can, because once we get that break of horizontal support, should that happen, things could accelerate dramatically and we could fall through some clear space very, very quickly, some 100+ points on the S&P futures. So that's the fear that we have, and that's what we have to guard against, while at the same time understanding while probabilities have increased for that, they certainly are not certain by any measure. So that's the crossroads that we're at this point. So that's probably enough for today. We're a little over 20 minutes. So let's go ahead and get to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And then also note the hyperlink down here at the bottom of the slide for the full set of disclosures. We'll see you back here with the next Falcon Global Market Preview for Monday. And in the meantime, manage that risk, and I think you'll find that many things will come together for you. In the meantime, also be sure to go out there and each and every day seek to learn something about your craft. Good trading.